I'm surprised that gold has taken so long to catch a bid, but I was surprised too in the early part of the decade of the 70s. Remember, Aditya, that people's anticipation of the future is set by their experience in the immediate past. And I think that individual institutional perceptions are consistent. In the late part of the 60s, the writing was on the wall with regards to inflation, with regards to the diminution of purchasing power associated with savings, at least if those savings were in debt instruments. But people's expectation of the future was set by their experience in the late 40s, the 50s, and the 60s, which is to say they'd been through 20 years of pretty good economic times. And the fact that they saw inflation in the period 1968 to 1972, what they saw in terms of inflation was troubling, but it wasn't terrifying, which is to say, yes, the price of gasoline went up. Yes, the price of bread went up. Wages went up too, but wages didn't go up as fast as inflation. I like to say that people regard inflation as an annoyance when the price of gas at the pump goes up, and they regard it seriously when they can no longer afford a car. Inflation is cumulative and compounding, and people have been trained to think in 3-month or 12 months increments. My suspicion is that if inflation continues at its current rate, or even at a lower but still historically high rate given the last 40 years, that concern about inflation will once again occupy people's mind. In the very, very near term, Aditya, and I use the 12-month time frame to describe the very near term, I see two factors. One, the denomination of most of the world's debt in dollars, and as a consequence, ongoing demand for dollars in global credit markets. And the relative strength of the US dollar, which may allow the Fed to continue to raise interest rates for a while, as being positive for the dollar, and as a consequence, troubling for US dollar denominated holders of gold. It's very important for you and the audience to understand, Aditya, if you're holding gold in euros or in yen or in renminbi or in rupiah, gold's done its job. If you're holding gold in US dollars, it's been a bit more challenging. But I'll reinforce, too, that things change very, very quickly. Prices do, in fact, climb a wall of worry. When you have a circumstance around you, which is to say negative real interest rates on savings products denominated in US dollars, a saver can be willing and able to afford the diminution of purchasing power on their savings for a year or 2 years or 3 years. Similarly, a very large institutional investor with 40% of his or her portfolio in long-term debt instruments can afford to ignore the deterioration of the corpus of that pension fund relative to the obligations that it will need to fund 20 or 25 years from now for a year or 2 years or 3 years. But at some point in time, you have a break in confidence. And I don't see that break in confidence having occurred yet.
It's interesting to watch it from this side of the fence as a gold investor. It seemed like all of this was inevitable. Jerome Powell recently said that there's a lot about inflation that they don't understand. I find it very funny that everybody believes that it's fixable. by the same people that didn't see it coming. For me, it seems a bit odd, and it seems overly simplistic as an explanation for why this asset class has not done what I and a lot of our clients that I speak to on a regular basis thought it was supposed to do. And that's why I've asked you this question before. And I was curious, having seen several cycles, I wonder whether your tolerance for surprises is different, or timeframes is different, or whether you feel it's something has changed.
As I've gotten older, as I've been through more cycles, I certainly have become much more realistic with regards to the timeframes I expect. I've told you before, Aditya, when I was a young man and I had lots of time left on Earth, I was strangely impatient. And I've told you, too, that I suffered from a very lineal thinking mentality, which is to say, if A is true and B is true and C is true and D is true, and if the logical outcome of that is something, I confused when I was young two words in English, inevitable and imminent. As I experienced more cycles myself, and as I learned the difference between those words, I developed a new mantra, which is to say, when I asked myself a question where the answer was much more likely than not to begin with the word when and not if, then I was asking myself a high quality question. And I certainly believe that to be the case in natural resource investing generally and precious metals investing too. There have been other points in time in my career when I have misinterpreted the fact that a circumstance had to occur with the fact that it should occur quickly. An example would be natural gas markets in the 1980s as a consequence of very strong price performance and hence very strong investment in the oil and gas sector. The decontrolled natural gas prices in the United States fell from about $15 per million BTU to about $1 per million BTUs. And the consequence of that is that capital investment in natural gas exploration in the United States fell like a boulder off a bridge. Beginning in about 1987 or 1988, I believed that U.S. natural gas prices had to rise. And they did, but they didn't for 4 years. What we thought was a gas bubble in 1983 turned into a gas sausage, where domestic gas, was priced at a discount to the incentive price for new productions for almost a decade. Similarly, the price of zinc stayed below the global cost of production for 6 or 7 years. And famously, of course, the uranium price in the period, for a very long time, but certainly for 4 years after I identified it as an investment theme, the price of uranium stayed depressed for 4 years until 2002, where it began to take off like an absolute rocket. So I suggest to you that understanding cyclicality in natural resources and also understanding the very long time involved in cycles, that the thing that's changed with me has been my tolerance for long time frames. If my certainty about the investment thesis, the economics around the investment thesis, not the narrative, remains intact.
It's a very interesting point, and this is a discussion I have with a lot of people about timeframes. Did you get anything wrong in your thesis itself, which led you to be 3 or 4 years early, or was it unknown events which occurred after that delayed the inevitable?
With regards to being early in the uranium space, probably what I didn't understand is the willingness of large investors to run the world's energy economy at that point in time on more expensive fuels rather than spend the capital that would have been required to increase the utilization in the near term of nuclear power. But it's worth noting that in both cases, while I was wrong in the short term, the arithmetic was inescapable in the longer term. I used to joke that if you were 4 years early on an investment theme at a 10% cost of funds, which is the way I used to discount in those days, you weren't early. You were in fact wrong. But what happened was that the rents that I got paid when those markets eventually turned, even at that high interest rate, was such that I overcame the time value of money very, very, very handily. The psychological damage that was done is still painful to remember.